Well, let's return to the markets right now and take a look at what's behind the latest moves in the markets today. We have our panelists with us, Dariusz Kowalczyk, Chief Investment Strategist, CFC Seymour. He joins us live from Hong Kong. And Mike Lenoff, Chief Strategist and Head of Research, Bruin Dolphin Securities, live in London. Derek, let me first start with you first. When you look at today's market rally, we've got weak dollar, high oil prices. Has today's market rally really changed anything?
I don't think it has changed much. It was kind of a dead cat's bounce following declines earlier in the week. And the bounce was triggered by better than expected ISM data out of the US, which is important for Asian economies because they are so dependent on US growth. And it seems that at least the services sector in the US, which is the largest part of the economy, is not doing that bad. That's why we had some move higher, but very cautiously. And I think that there will be further declines in the weeks to come.
Mike, yeah, we've got, oil prices up near record highs at the moment. We've got gold, heading towards the 1,000 and other commodity prices doing pretty well. Is this still going to be supportive for the commodity stocks that are a lot of them listed here in London?
Well, I think it will be supportive up to a point. It's a question of whether that's going to be enough to drive the markets ahead. Certainly in London, I think there's a lot of resistance around 6,000, 6,200, as we know, as we found out. So even if gold goes to 1,000 and above, we've already got $100 oil. I just don't think it's going to be sufficient to really push the market ahead. So I just think we're going to see more of the same, a bit more volatility for a period of time. What really matters, the important thing is getting interest rates down. We heard about the prospects for the ECB and today here in the UK, but eventually I think the antidote to all of this is really just getting interest rates down, and it's happening in the US, and more of that I think is what's required really to push these markets ahead.
But because of these the commodity price rise, we've got this supply-side inflation, which is obviously causing a bit of a headache for central bankers, as we heard from the ECB and the Bank of England. Do you think interest rates are going to come down fast enough, or do you think actually what they're going to prepare to do is actually say we're going to have to slow the economies down a lot before we decide to cut?
Well, I think a couple of points here. One is that we already have the contractionary influence of the credit crisis. That is slowing things down. Keeping interest rates where they are will slow things down. In fact, last month when the MPC cut interest rates, it acknowledged that the justification for doing so was the spreads, the widening spreads in the credit markets. So that is actually a restraining influence right now. But I'd also argue that so is inflation, so is commodity prices, so are commodity prices, because what's happening is that is really squeezing real disposable income and really just compounding the contractionary influence and the disinflationary influence of this credit crisis. So they may delay or postpone cutting interest rates for a couple of months, but I think the longer they postpone, the deeper or the severe this disinflation ultimately becomes, and the greater impact it will have on the economy. So eventually, interest rates are going to have to come down. I just don't see any other way around it.
I want to put this question to Dariusz. Brian Shackman here in the U.S. The Beige Book talked about slow growth, but it wasn't negative. And then we have this jobs report coming out tomorrow. What do you expect, and do you think it'll give us some clarity on the whole question of U.S. recession?
I believe that the jobs report will be close to expectations, which are pretty negative right now. Our call is for still adding 30K of payrolls, which is slightly above consensus, and maybe some upward revision for previous months. But 30K, and if previous months is around 0, would still be consistent with very sharp slowdown, if not recession. So the markets will conclude that this is a confirmation of a negative trend in the U.S. economy. Whether they conclude it's a recession, I don't know. I personally believe that the U.S. will skirt recession, that growth will just grind almost to a halt, but that we will still avoid recession because the consumer will still manage to spend enough to outweigh the negative impact of recession in construction. So I think we will have a slowdown, but negative payrolls data will weigh on equities at least in the near future.
Dariusz, here we are worried about the U.S. economy, but how worried are you about the China stock market? Because we have all this extra liquidity coming on from these Chinese companies. Is it going to trigger another sell down that could perhaps trigger another global meltdown?
The Chinese equity markets are indeed under some cloud of supply overhang, as a lot of the lockup period for many stocks is coming to an end this year. But on the other hand, I think that the market has corrected quite substantially. And when you look at how much price-earnings ratios declined across the globe, China is the one that saw the biggest decline. So the market here does not look that overpriced anymore. And there's another major factor being that the Chinese government would like, I think, to have gains in the stock market in the run-up to the July Olympics, to make the country look better, to make the population look more satisfied. So I think that they will, allow more funds to be opened and take other measures to ensure that there will be gains. My outlook, therefore, for the first half of the year for the Chinese stocks is fairly positive. I don't think that it will be a trigger of any global, catastrophe in the equity markets. Global stocks will decline, but for their own reasons.
And Mike, you're waiting for interest rate cuts here in Europe. Are you still happy to play stocks that leverage, the growth story out of Asia?
Yeah. I mean, I think that, we've obviously been obsessed with what's been happening in America, and the whole media and sentiment is really being influenced by what's happening there. But there is a big, wide world out there. And a strong part of the global economy is Asia, and in particular China, as we just heard. So I think that, and there are parts of the UK equity market that clearly are exposed globally and specifically to that region of the world. So yes, I think, and the other point is that they're not just, some of them are defensive growth situations, some of them are cyclical, like your mining and so on. So yes, I think that this is an area that would want to continue to look favorably upon.
Okay, Mike, thanks very much indeed for that. Mike Lenhoff, Chief Strategist and Head of Research at Brewin Dolphin Securities. Dariusz, thank you. Dariusz Kowalczyk, Chief Investment Strategist at CFC Seymour. Now, some of the